Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasury yields fall as investors reassess bets on US rate cuts and risks from the upcoming election. A 22% surge in Tesla shares drives a gain for the Nasdaq. Here in the UK, government bonds slide as Chancellor Rachel Reeves says she will change the fiscal rules, potentially allowing her to borrow an extra £70 billion over the next 5 years. Plus, Barack Obama and Bruce Springsteen join Kamala Harris to rally voters in Georgia, while Donald Trump targets Arizona and Nevada. We will have the latest. We are, of course, in the middle of earnings season. Mercedes cars coming through with the latest numbers. Third quarter adjusted return on sales. The number coming in at 4.7%. That is a big miss from the estimates of more than 8%. This is, of course, a car maker that cut its outlook for the full year earlier, about a month ago, on the challenges in the Chinese market, of course. And any commentary in terms of sales into that crucial market for Mercedes will be front and centre for analysts and investors, as well, of course, the profit and margin story. We're going to get the details right now with Oliver Crook, who's standing by to break down the numbers for us. Ollie, what stands out to you?
Yeah, Tom, it's got to be that margin target, the return on sale that is absolutely missed in a really very big way for Mercedes-Benz. So listen, the market was expecting about 8%, a little bit over 8% on margins, coming in at 4.7%. By Mercedes standards is exceedingly weak. We already knew this was going to be a weak quarter. We got their delivery numbers a little bit earlier in September. Overall, their deliveries were expected to be down 3% overall, down 13% in China. For electric vehicles, down 31%. So overall, we knew this was going to be a poor quarter. But that number, that margin number, really stands out, Tom. And we should also say we got some of their guidance looking forward in the statement here, saying that for the full year sales, they're going to be slightly lower this year than they were last year. And their guidance for their return on sales for the full year is going to be about between 7.5 and 8.5%. That is really not a very strong number coming from Mercedes-Benz. When you look at all of their other sort of metrics for the quarter, revenue down 7%, earnings before interest and taxes down 48%, net profit down 53%, earnings per share down 47%. It paints a fairly grim picture for Mercedes-Benz this morning.
Yeah, it does indeed. Just looking again at that key profitability gauge that you were highlighting for us. So dropping to 4.7% in the third quarter, as you marked, of course, that compares to 12.4% a year ago. So almost a third of the levels in terms of profitability that we saw just 1 year ago. They're talking about cost cuts. That is one solution they're reaching for. Talk to us about how that is playing into expectations for the car maker. It's not the only one, of course, that's struggling.
Yeah, listen, Tom, I mean, this is a story for German automakers across the board. If you can't have the demand, you can't get the margins up, can't have that pricing power, what do? You have to cut costs. We're seeing that story over at Volkswagen. We're going to, be anticipating that across the European car sector. One sector, Tom, though, we should mention, we're talking about that number. I just want to bring this to the attention of everybody. The return on sales for Mercedes-Benz at 4.7%. Tesla, yesterday, delivering their margin, 17%, Tom. 17%. The estimate had been for 15%. They blew it absolutely out of the water. And just to give a little bit more context for the comparison from what's going on in the United States with Tesla and what's going on here with Europe, we had that rally of Tesla of 22%, Tom, almost by a quarter. That means that they added $153 billion worth of market cap. If you take the combined market cap of Volkswagen, Stellantis, BMW, the move on Tesla yesterday was more than all three of those combined.
Yeah, it's remarkable, isn't it? The divergence that we're seeing now in the auto market. Maybe it's less divergence, it's just one car maker breaking away from the pack. And it certainly gives sustenance to the view from the likes of Cathy Wood, who have long bet on Tesla, of course. Oliver Crook, thank you very much indeed. What a remarkable day for Tesla yesterday. And we will be watching, of course, the European automakers on the back of the numbers coming through from Mercedes and the miss there in terms of that key gauge of profitability. Let's check in on these markets then. Certainly the earnings story will be part of the calculation of investors as they gear up for the day today. today. It's a bit of a lackluster session so far in terms of how the setup is unfolding. Currently, European futures pointing lower by 0.4%. We will watch the DAX and the automakers closely. The FTSE 100 pointing lower just by 6 points. S&P futures currently off by 3 points after some gains of around 0.3% yesterday. Nasdaq 100 futures currently flat after rallying 0.8% in the session yesterday, boosted, of course, by that 22% pop for Tesla. Let's flip the board and have a look cross assets. Yes, that relief around the sell-off, the bond market sell-off stateside continues. It has eased for the last couple of days then. You've seen a bit of money moving back into US Treasuries. You can see the benchmark US 10-year back below 4.2 as a level. Interestingly, yields currently down 2 basis points in the session. Euro-dollar at 108. We heard from Joachim Nagel on the hawkish end of the spectrum, saying the ECB should not rush to cut that much further, although he did say that 2% target is well in view for the ECB. 108 on the single currency. Brent 74.54, currently up 0.2%, and gold currently off 0.3%, but still above that 2,700 level. Let's cross over to Singapore right now for a check on the Asian markets, building up to an election, of course, in Japan. Avril Hong standing by for us.
Absolutely, Tom. That is really the focus today. Even though we're seeing Asia benchmarks mostly higher, tracking Wall Street, Japan is the outlier as we head into an election weekend. Polls show us that the ruling coalition could lose its majority. Those concerns about policy implementation, those concerns about whether this slows the pace of normalization of monetary policy, fiscal consolidation. Of course, it's not just about politics in Japan. Next week, we got the BOJ. And this week, Governor Ueda has been sounding pretty dovish. He says they have time to consider their next steps, which suggests no move in October, although that was never really on the table. It was more about December and January, but there are still those uncertainties given politics in Japan, given what we've seen potentially from the BOJ in terms of messaging, and perhaps that speaks to why dollar yen is quite flat today. A bit of a reversal or, breather from the gains of just a day ago. But let's flip the board, take a closer look at what we're seeing in stocks in Japan, because in the lead up to this weekend, we've really been seeing the topics underperforming developed market peers. But this is also something that could reverse if we see an inconclusive election and there's a slowing in policy implementation. That could make the BOJ actually maybe think twice about its rate hikes, keep monetary settings easy for longer. That is an environment that's helpful for Japanese stocks. So we could see this a dynamic that reverses, so say some of our colleagues on the MLive team. Let's flip the board again. I wanted to highlight what we're seeing in terms of implied volatility on dollar yen, because the 2 week is higher than the 1 week, and 2 week encompasses the Fed as well as the US election. So it gives you a sense of what traders are really watching out for as well.
Yeah, that implied volatility, certainly the moves around the Fed, certainly US elections also a factor in terms of that volatility. Around the Japanese yen, we look ahead, of course, to that election on Sunday, as you say. Avril Hong with a deep dive on the Asian markets this Friday. Joining us out of Singapore, thank you. To the UK now, where Chancellor Rachel Reeves says she will change the country's fiscal rules to boost government investment. It is a move that could allow Britain to borrow as much as £70 billion more over the next 5 years. Let's bring in our UK correspondent, Lizzie Burden. Lizzie, this has been flagged for some time. It is still significant, of course, gives her that headroom in terms of investments. Why then is the Chancellor making this move? Has she faced some pushback?
Well, what she's specifically doing is changing how debt is measured so that she can maintain the golden rule of only borrowing to invest and funding day-to-day spending with tax revenues. Now, she's towing this line between maintaining fiscal credibility, not returning to austerity, and not raising taxes on working people. It's a really tight set of limitations they've given themselves to get elected, and therefore it is absolutely crucial that Labour can convince the markets that this borrowing is going to stimulate growth, hence why she's doing all the pitch rolling. She's done this speech at the IMF in Washington. There was a Guardian story, there's been an opinion piece in the Financial Times, and yet you still saw this market wobble yesterday. The yield on 10-year gilts falling, the spread between gilt and bund yields widening, and that's because of the prospect of increased borrowing, leading markets to pair bets on the scope for BOE rate cuts, despite Andrew Bailey saying, look, disinflation is happening, and he had already said that that was a condition for more aggressive cuts. So what you can see is this gilt move is more of a fiscal story than directly a monetary one.
Yeah, and we'll see how sensitive the gilt market is to this change, this adjustment to the fiscal rules for the Chancellor, and of course the sensitivity around that key budget, which of course you will be covering for us in detail next week. UK correspondent Lizzie Burden, thank you very much indeed. Let's switch focus to the geopolitics right now. Negotiators between Israel and Hamas will meet in the coming days as they make a renewed effort to end the conflict in Gaza. US Secretary of State Antony Blinken is in London to meet Arab foreign ministers later today as the US explores different options to reach a ceasefire. Let's go to Bloomberg's executive editor for the Middle East, North Africa and Russia, Stuart Livingston-Wallace, for the latest. Stuart, we've seen this a number of times before. What was the 11th visit by the Secretary of State to the region? Now he's in London. What are the chances of a ceasefire at this point?
Yeah, morning, Tom. I mean, I think that the chances are pretty vanishingly low at this particular stage. Now, of course, strange things do happen, but let me set up sort of the scenario that they're working with. Number one, it's not even clear they have a text to negotiate around. Number two, there is not a leadership in place in Hamas, so who exactly are you negotiating with? And then number three, the appetite within Israel for a ceasefire in Gaza, at least along the lines of what's been previously discussed, does not seem very high. They have a very specific set of circumstances that they would prepare to agree to, and it doesn't look like any of the other sides would be particularly keen on those. So there is clearly a willingness there in the international community to push things forward, but I think the reality on the ground is that we're a long way off being anywhere near something that's negotiable at this stage.
Stuart, talking of the reality on the ground, give us an update as to what is happening both in Lebanon and Gaza and the calculations that Israel continues to make about whether or not to retaliate against Iran. Has that become less of a risk for this region?
No, I think in terms of that retaliation, it certainly feels inevitable at this stage. Again, we're not inside the minds of the cabinet in Tel Aviv and Jerusalem, but nonetheless, I think they will have to do something, and all the indications are that they will. I think the question around that will be what exactly will that look like? And again, based on the reporting that we've seen out of places like Washington, they've probably stepped away from an attack on the nuclear facilities. They may have stepped away from an attack on the oil or the energy facilities. So we're looking probably at military targets of one form or another. And again, it will depend on the scale of that, of whether Iran in turn feels like it has to retaliate in kind. And then you get this sort of tit-for-tat exchange. I think the best case scenario is probably a repeat of what we saw in April, where you had this massive attack by Iran on Israel, but it actually did very little damage, if any. And then a sort of a very muted response from Israel, presumably under pressure from the US, and that de-escalated things again. So I think that is probably the scenario that the international community is hoping for this time. But again, when a great deal of armaments are flying around the region, mistakes are easy to make, and then things can get out of hand, and that is the real concern here.
OK, Bloomberg's Stuart Livingston-Wallace on the options being weighed out potentially by Israel and, of course, being characterised, the ceasefire talks, as vanishingly slim hopes at this stage. We continue to monitor those developments for you, of course. Coming up, less than 2 weeks to go, Kamala Harris is tapping into the power of celebrities, while Donald Trump is employing different tactics to fire up his base. We're going to bring you the details next. This is Bloomberg. Welcome back. Happy Friday. Now, ECB Governing Council member Joachim Nagel says the central bank should not hurry too much to lower borrowing costs, but remain flexible. The Bundesbank president told us all options are on the table for the December meeting.
We shouldn't be too hasty. We should be cautious, keep our track to really look what data is coming in. We have in December, when our next meeting is coming, we have our new projection. The new projection will include the year 2027. And then we have maybe more guidance, more orientation. But I'm not in favor to speculate too much what is necessary in our December meeting. This is definitely, I believe, not helpful.
OK, let's bring in Bloomberg's Valerie Teitel for the reaction to this. Val, ECB members, they are still debating whether or not they go 50 basis points in December. The market's also in something of a debate mood around this question. Where do things stand?
Yeah, we just heard there from Nagel saying he doesn't want to speculate. But, Tom, the market is very much speculating on what the ECB will do in December after this raft of weak data we've gotten from the Eurozone. If we look at what's been priced in now, there's two meetings. So over December's meeting and January's meeting, we're now pricing in 70 basis points worth of cuts. So that is really implying that one of the next two meetings is going to be a jumbo cut from the ECB. But we've heard more skepticism from ECB members talking alongside at the IMF meetings in Washington. We heard from Peter Wunsch yesterday. Take a listen.
I know some of my colleagues are already discussing cutting 50 basis points in December. We'll have two more readings of inflation before we have new projections. My take on it is, of course, the European economy is weaker than we thought, and we had an inflation surprise on the downside in September. But I think, honestly, talking about a 50 basis point cut in December is premature.
Maybe it's a bit too premature, Tom, but the market is sure pricing it in. If we just look at how the euro has performed since the start of the month, it is down nearly 3%. That's alongside this repricing of further cuts from the ECB and a bit of dollar strength with regard to election risk. And I want to flip on and just show you what is the risk being priced into the euro-dollar options market. We've seen implied volatility really rising over the past few weeks. This is the 1 month implied option volatility on the euro-dollar pair. It's really picked up, showing that there is a lot of skepticism about a Trump win and what that could mean for the euro. We've actually heard in a note from Goldman, they say on the risk of a Trump win and an escalation of the tariff war, they could see a 10% decline in euro dollar.
Wow, a 10% decline in euro dollars. We're on track for a fourth straight week of gains for the dollar. Bloomberg's Valerie Teitel breaking down the expectations, of course, around these central banks. Some hawkish commentary from a number of ECB officials, but markets still debating, at least putting some bets on a jumbo cut in December. Let's get to US politics right now. It ties into all of this, of course. Vice President Kamala Harris enlisted rock legend Bruce Springsteen and former President Barack Obama to help turn out the vote in Georgia, a key battleground state where voting is already underway. Meanwhile, former President Donald Trump headed out west to Arizona, where he railed against illegal immigration. Bloomberg's opening trade anchor Kriti Gupta joins me now for the latest. Kriti, different tactics, different strategies. What have we been seeing from both candidates?
Well, you can kind of see where they're putting the emphasis on in the last couple of days on the campaign trail. And I think the idea that they're both going down to the southern border, and specifically Texas, is very crucial. Remember, one of the main key voting issues this cycle is immigration at the end of the day. It's abortion. Of course, it's gun control. Economy is number one. People are very kind of sensitive to the cost of living there. But immigration is high up on that list, specifically in terms of the context that you're seeing around the world. I believe in the last 24 hours, 48 hours, even Justin Trudeau out of Canada is putting on some pretty strict measures when it comes to immigration. You certainly hear it as a hot topic here in Europe as well. This is going to be crucial because Harris has, of course, faced a lot of criticism on the fact that she was the AG over in California and did very little, at least the criticism is, did very little to address the border issue. So how is she going to do it as president? Trump, of course, being grilled, on the other hand, around his stake around the border wall. And we have it partially constructed between the southern border and Mexico, but not fully constructed. And just to see how effective it is. Of course, if you look at the numbers, for example, in the last couple of months of, I should say, Biden's administration, you have seen the migrant numbers actually drop pretty substantially. We don't really know what that's attributed to, but it is a fair point and very much on the ballot this time.
OK, yeah, immigration, arguably a vulnerability for Kamala Harris. When she does these celebrity endorsements and stands on stage with celebrities, I believe she's going to be alongside Beyonce at some point in the next couple of days. What does history tell us about whether or not that actually moves the dial?
So I think it depends on how big the celebrity is. I think Beyonce certainly fits that bill. So basically, I think that the news that people need to know is that this was a very hot topic when she played Beyonce's Freedom in previous campaign rallies. You, of course, have to get the celebrity's endorsement to play that song. She has now gotten that a couple of, less than 2 weeks before the election. It brings back a lot of questions about the endorsement from Taylor Swift a couple of months ago for Kamala Harris as well. This idea here simply being, how can you reach out to minorities, to women, especially around this voting issue. And it feels like this might be one way to do it. We know this has been a key part of the Harris strategy, which is reaching out through celebrities, social media, TikTok, etc. We'll see if it works.
OK, Kriti Gupta, opening trade anchor on the US election and the campaigns as they continue, of course, fewer than 2 weeks, of course, before that election, November the 5th. Kriti, thank you very much indeed. Now to Elon Musk, who has, of course, playing his own role in this election with the support for Donald Trump. He's reportedly been in regular contact, here's the wrinkle, with Russian President Vladimir Putin since late 2022. According to the Wall Street Journal, former officials from the US, Europe and Russia said the pair discussed business, geopolitical tensions and personal topics. The report raises sensitivities given Musk's ties with the US military and intelligence agencies. Coming up, the future is nuclear, at least according to big tech. We're going to look at what's driving investments in the sector by Microsoft, Amazon and Google. Right now, we're going to give you a bit of a pause as we check in on the markets then. European futures currently pointing lower by 0.4%. As you can see, FTSE 100 futures just off by 5 points as things stand. DAX futures in focus on the miss, at least according to the top line on the profitability gauge for Mercedes. A big miss there. That could weigh on the DAX. DAX futures currently down 0.4%. The read across to the broader autos sector as well on the results coming through from Mercedes. We continue, of course, with the macro lens to focus on the repricing around the Fed and the ECB to some extent. To what extent are the central banks going to diverge next year? Markets currently pricing in still 34 basis points in terms of the cut that is expected from the ECB in December. The bond market sell-off in terms of US Treasuries has eased in the last couple of days. Let's get back to the technology story. Big tech companies making a dash for nuclear power. It's a really fascinating development. Microsoft's push will see the infamous 3 Mile Island plants in the US reopen its doors. Amazon and Google, meanwhile, are investing in small modular reactors. Here to tell us more is Carl Harrison, Head of Sustainability Research at Bloomberg NEF. Carl, what's driving then big tech's recent push into nuclear power? They're taking different strategies. Some of these are kind of mothballed plants that are being revived, some of them new technology. How much of this is about AI and making sure the energy needs are there to support these massive data centers?
Thanks, Tom. I would say there's 3 primary drivers for this. So the first one is power demand. We're obviously seeing a lot of news around AI-driven power demand from data centers, but technology companies have seen their electricity demand grow significantly over the past couple of years. So between 2018 and 2023, 4 of the largest technology companies, Amazon, Google, Microsoft, and Meta, they saw their electricity demand grow 300% on absolute terms over that time period. And year on year, that electricity demand grew 27% on average. So it now is AI, and AI is driving a lot of that demand moving forward. But previously, it was cloud computing as well. So power demand is one side of this. The other kind of main driving factor, or the second one, is the drive for clean electrons. So all of these technology companies have set clean energy targets and carbon-free electricity goals. And what they've committed to do is that anytime they're building a new data center or any type of new asset, they're ensuring that that's met with zero carbon-free electricity. But of course, solar and wind and some of these other renewable technologies are intermittent. And that brings us to kind of the third major driver, which is reliability. These data centers need reliable power over the course of the day. And nuclear and several other technologies, which form that kind of zero baseload carbon-free power, they can really kind of go in and fill the void. So those have been the 3 biggest drivers.
Is it your expectation, Carl? It's really fascinating. Is it your expectation that we're going to see more deals of this type focused on nuclear power from the tech sector, more spending on this kind of utility going forward?
I think it depends on what type of nuclear we're talking about. So you mentioned Microsoft reviving 3 Mile Island. That obviously got a lot of attention a couple of weeks ago. But for the first time since 2007, there is no large-scale nuclear reactor under construction in the United States. And of course, there's limited opportunities to revive some of those previously retired nuclear projects. So at a large scale, some of these larger projects, you're not necessarily going to see that big traction from big tech or other sectors again. And on general, right, on average, these large-scale nuclear reactors can take upwards of 10 years to build when you add in permitting and the construction process. Of course, the X factor here is these small modular nuclear reactors. And that's, of course, the announcements that we've seen recently from Google and Amazon. These are smaller projects. You can kind of plug and play them in various facilities and develop them on site. And so there's still some question marks that we need to answer around SMRs. The costs are uncertain. Obviously, the first projects are expected online around 2030. So there's a few question marks there. But if you can bring that technology into commercial viability, that opens up the door not just for big tech to sign more of these nuclear deals, but for a whole slew of other sectors to get involved in the space.
Is it just about nuclear, or are these companies reaching for other energy sources? Just briefly, Kyle.
It's going to be all the tools in the toolbox. Nuclear is one of those zero carbon baseload forms of power, but renewable energy has also been very prominent here. So big technology companies in many parts of the world are the single biggest driver of clean electricity supply. So companies like Amazon, Meta, Microsoft, Google, Apple, they've gone ahead and they've signed gigawatts of power purchase agreements for clean energy.
Okay, Kyle, we have to leave it there. Really fascinating insights. Kyle Harrison, Head of Sustainability Research at Bloomberg NEF. Coming up, a focus on the UK debt markets ahead of the budget. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasury yields fall as investors reassess bets on US rate cuts and risks from the upcoming election. A 22% surge in Tesla shares drives a gain for the Nasdaq. Here in the UK, government bonds slide as Chancellor Rachel Reeves says she will change the fiscal rules, potentially allowing her to borrow an extra £70 billion over the next 5 years. A Mercedes says it will step up cost cuts after fierce competition in China saw its car-making margin slump well below the target. We have more earnings crossing the Bloomberg terminal right now. The redhead crossing in terms of Rémy Cointreau, of course, the makers of cognac, listed over in Paris, cutting its full year sales guidance. So a cut to the full year sales guidance by Rémy Cointreau. In the second quarter, revenues coming in just marginally below the estimates, 316 million euros. The estimates have been for 317 million. When it comes to organic revenues, that was a contraction then of 16%. The estimates had been for a contraction of 15%. And no doubt the mix around the exposure to China, but also the US, will be part of the picture. US sales failing to recover for Rémy Cointreau, cutting their guidance. More redhead crossing, this time from the energy company Eni. It says full year pro forma adjusted EBITDA of 14 billion. That is a miss versus the estimates of 15 billion euros. We're also going to bring you the redheads from the French drug maker Sanofi on the lines coming right now. That drug maker, by the way, up. The stock up about 13% year to date. We are focused on any lines around the consumer part of the business and, of course, any details on the guidance from Sanofi. Again, the stock up 13% year to date. It is a miss in terms of third quarter business earnings per share for Sanofi coming in. It's a beat, in fact, 2.86 billion euros. It's a beat when it comes to third quarter business EPS for Sanofi, 2.86 billion euros. The estimates had been for 2.5 billion euros. In terms of the key and blockbuster drug, which is Dupinext, net product sales coming in at 3.48 billion for that particular drug, on which, of course, Sanofi's gains year to date have been quite reliant, coming in above the estimates, just shy of 3.5 billion euros. Operating income, by the way, for the third quarter, also a beat, 4.6 billion euros. The estimates had been for just 4 billion euros. So it's a beat for Sanofi in the third quarter. Let's check in on these markets. Earnings clearly will be factored in, as will expectations around where these central banks go, the election risk, and, of course, the geopolitics of the Middle East. European stocks currently down 0.4%. FTSE 100 futures currently flat. S&P futures also in similar territory. Nasdaq futures just eking out some very modest gains after the upside that came through yesterday, powered by that 22% gain in Tesla. The Nasdaq 100 ended the session up 0.8%. Let's flip the board and look cross-asset. A bit of relief coming through for US Treasuries after the sell-off that we saw at the front end of the week. Currently, you're seeing yields down close to 4 basis points on the 10-year, comfortably below that 4.2 level right now, 4.17 on the benchmark US 10-year. Euro-dollar at 1.08. You're looking at 4 straight weeks of gains for the dollar. By the way, 74.60 on Brent, that's up 0.3%, and gold just off by 0.3, but still above that 2,700 level. Now, UK bonds fell yesterday as Chancellor Rachel Reeves opened the door to more borrowing in next week's budget. Reeves plans to change the fiscal rules to allow for more borrowing for investment. It's a move that sent jitters, as we mentioned, through that gilt market. Joining me now is Experian senior economist Josie Anderson. Josie, talk us through what your expectations are. On some analysis coming through from the Bloomberg reporting, Rachel Reeves now has scope under this change in rules to borrow up to £70 billion over a 5-year period. Is that your expectation of the scope that the Chancellor has? How much do you think she'll use?
So we're certainly talking about tens of billions of pounds here in extra money that the government can spend with these new fiscal rules. And the key here, I think, is that they spend it on investment, which is the plan. And when we look in the context of the UK economy at the moment, we have seen essentially productivity growth flatlining since the global financial crisis. And a key fix here that economists talk about a lot is investments in key infrastructure and key skills that could increase that productivity. Because we should have seen productivity rise. It's increased in other countries, and we've had technological advancements in that time, but it hasn't. And so if the government can succeed in investing in the right things, then we should see productivity growth rise and indeed GDP growth rise. And so I think the key here is that the government does invest, and it does invest in the right things. It attracts private investment alongside that government investment, and we unlock productivity growth as a result of that, because that is the big problem with the UK economy that we've seen for the last 15, 20 years, is that lack of productivity growth, and investment should be a key fix for that.
OK, and we'll see if the Chancellor gives the details on the exact numbers. That should be expected, of course, in the budget next week. Given there's uncertainty, this may be a tricky question to answer, but what do the models suggest this kind of spending can do for growth in the medium to long term? How does it change your forecast for UK growth?
Yeah, so when we think about our current forecast, we're forecasting 0.9% GDP growth for this year, and then to accelerate over the coming 5 years. But we're not forecasting growth to reach 2% within our forecast horizon. And so, as I said, if this investment manages to unlock increased productivity growth, then that leads to higher GDP growth. I think the question is, what will that investment look like? The government's talked about things like a national wealth fund, so that would invest in things like ports and gigafactories, and so that will all be incorporated into our forecast next week and next month when we get more details, but that will be a longer term impact. That 0.9% for this year is looking pretty likely.
What did you take from the gilt market reaction and the sell-off that we saw this week? Does that suggest there is sensitivity around this budget? Will the debt markets stomach this?
Yeah, so when we're looking at the debt to GDP ratio in the country at the moment, it's nearly 100%. So there is nervousness about the fiscal situation. Public finances are a sensitive area, and we have seen gilt markets move. They're likely to move again next week, and the Chancellor will be acutely aware of that. And so this is why we're also likely to see tax rises, so that she can demonstrate some reliability with those finances that she is now responsible for. And so it's pretty difficult to predict exactly how markets will move. We've seen movements from this announcement already that then will likely be priced in. So hopefully there won't be a dramatic change next week as well. But yes, the Chancellor has a tough path to walk, and a narrow path to walk, because she's promised not to raise things like personal taxes, but she's also, got to demonstrate that responsibility with the public finances.
And to be clear, those tax increases are factored into your 0.9% call for the UK economy by the end of this year. You're factoring in some of that increase.
Well, at the moment, it's pretty tricky to factor in exactly, because we haven't had the full announcement of things like timings and exact figures. But I think that actually the key takeaway from our forecast is that with that 98% debt to GDP ratio, there is only so much that our forecasts can change because there's only so much the government can do with the money they have.
Do we get below 4% from the Bank of England next year?
So we're forecasting a rate cut in November, so in 2 weeks, and then 3 over the next year. So that is 4% by the end of the year. So that should, unlock, more spending in terms of it's slightly cheaper for businesses to invest.
OK, markets are betting on sub 4% by about May of next year. So you're looking at a less dovish reaction from the BOE. Josie, thank you very much indeed. Fantastic to have your insights, of course, this Friday morning. Join us around the studio. Experian senior economist Josie Anderson on this UK economy. Coming up, against tough macroeconomic environment, European VC funding has been slowing down. One fund, though, has managed to raise a sizable chunk of capital. We're going to speak exclusively to General Catalyst's managing director about their latest funding announcement. That's next. This is Bloomberg. Welcome back. Now, the EU has teamed up with leading venture capital firms from the region to boost investment in tech innovation across the region. Founders of some of the continent's largest unicorns have backed the calls for a single pan-European entity to promote startups and innovation in the bloc. That's as Europe's tech sector seeks to compete with the United States and China. And against this backdrop, VC firm Global Catalyst has raised $8 billion in new capital. The firm's managing director, very pleased to say, Jeannette Furstenberg, joins me now for an exclusive conversation. Jeannette, thank you for joining me. It's a big raise, $8 billion. What does it tell us? What does it signal about appetite for investing in tech globally, but also with the pivot to Europe?
Good morning, Tom. Well, listen, I think it signals that we have a very strong confidence in this next wave of technology transformation. We're very much focused on applied AI and global resilience, which are two sectors that are specifically relevant to Europe, and we're doubling down on these. And I think our LPs have a very strong confidence in us delivering great returns after having backed, companies like Stripe, Instacart, and Airbnb in the previous cycle. We're now up to doing the same thing in this cycle around.
Yeah, and certainly when it comes to that resilience, when it comes to defence, I'm thinking of Helsing, which is a key part of your portfolio. You've got Mistral, of course, in France in terms of the foundation models. Jeannette, talk to us. When I talk to venture capital firms and partners, they have talked about a challenging fundraising environment. Have you faced the same challenges at General Catalyst? Is that environment starting to ease? Are LPs starting to put more money to play?
Tom, actually, we haven't seen that ourselves. I do feel like it's a general industry trend. We've actually been very successful in raising $8 billion in new capital this fund cycle. And I think it comes down to just a long time trust and support that our LPs are showing us. And it also shows that we are very differentiated as a company. So we don't really think about ourselves as a pure play venture firm. We really think of ourselves as a global tech investment firm that also has transformation capabilities and very much focuses on early stage at its core. So that's a very differentiated approach that LPs are very much endorsing.
When it comes to early stage and late stage, to what extent, how are you going to divide up this $8 billion versus early stage versus late stage? We know Europe has challenged with the growth stage in terms of funding. Are you looking to address that piece?
Yeah. Listen, we have $4.5 billion earmarked for core venture. That includes early stage and growth for us. There's actually a really strong focus for us to really double down on seed founders and making sure we really bolster the strong talent base that we have in Europe specifically. So we are really working with early stage talent and really making sure that either we go behind them when they are backing or building their own companies, but we're also starting companies with them. So we have a very unique approach in the sense that we're creating companies, we're hatching companies alongside industry partners, and we're really doubling down on what we like to call global resilience. You mentioned Helsing, that's a great example of a defense company that's really kind of going after AI in this sector, which is a really interesting and important sector to double down and build in. We're aiming to do similar things in energy. We're aiming similar to do things in manufacturing. So these are very, very large sectors that are really fun and great, I think, sectors to go after from a venture capital perspective and for us to double down in.
Jeannette, I don't want to sound hyperbolic, but when you mention Helsing, I think of some of the other defence firms in Germany, some of the threats, frankly, to some of their executives. Do you worry at all about retaliation from Russia? Have you put in any security measures as a result of this investment?
Absolutely. I think companies have to be more careful. There's certainly, I think, security measures that have been put in place at Helsing. But I do think that if you think about the opportunity and the strength of these entrepreneurs, then they are very unwavered in their ambition and in their actual commitment to the sector and to making a difference in this very unique moment in time in Europe.
The other key investment, as I mentioned in your portfolio, is Mistral in terms of the foundation model, seen very much as a kind of potential European champion on that front. There's been some reporting, Jeannette, you're probably aware of, that maybe it's become an M&A target. Would you encourage the team there to consider selling? Do you think Macron would be OK with that? How are you thinking about those conversations?
Well, Tom, these are market rumors that I cannot confirm at all. And Mistral is actually doing really well on a standalone basis. Actually, I think it's a very unique category leader that's coming out of Europe that has a potential to actually own open source infrastructure, which if you think about the evolution of applied AI and, this whole sort of AI sector as a whole, is a very much needed component to make this technology succeed in this next cycle. I don't think companies want to be dependent on two companies that are really very much endorsed and owned by hyperscalers. So I think Mistral has a very strong opportunity to really own that sector and really double down from a global category leadership perspective.
And what does your investment in Mistral tell us about where you want to be situated in that AI stack? Where do you see the opportunity going forward in terms of the AI stack and Europe's role in that?
Well, I think the real opportunity we are seeing is what we like to call applied AI. And that for us comes down to the fact that we want to make sure we actually build these applications and really work with established industry partners to shape what will be actually the use cases that come with AI. So if you think about the past, and we've really been very much focused on offshoring a lot of these service industry. If you think about, call centers, if you think about, law, accounting, all these services have been offshored in the past. And I feel like AI really is what we like to call a workforce transformation. So I think the real opportunity we have right now is to nearshore some of that productivity, bring it back to Europe, build companies, back founders that want to build these companies, and then really scale them up with capital and really make sure we can regain some of that productivity and bring it back to Europe. And I think if you think of the opportunity at large that sits behind that, I feel like we have the opportunity to really play catch up against the US and China. I think we have the opportunity to really build 3 out of the 10 largest global technology companies out of Europe. I know it sounds like a bold ambition, but we are bold and we are ambitious in the way that we want to back and think about technology in this next decade of venture funding.
Yeah, OK. 3 out of the 10 largest tech companies out of Europe. It sounds like you may have been having conversations with Mario Draghi, because it seems to align with much of the Draghi report. Before I let you go, the conversations about a European entity to kind of support startups, is that something that you and General Catalyst would support? Does that sound like a sensible idea? Would it be effective?
Absolutely. I mean, we recently launched something called the General Catalyst Institute, which is actually an innovation framework that we're offering up to policymakers to really work with them on an innovation-friendly policy framework around, this next decade of AI and some of the global resilience themes that we're covering. And I think there's a really big opportunity for us, if you think about the Draghi report, that really addresses all these challenges we have from a technological sovereignty perspective, to double down and really sort of embrace this whole problem set a little bit more wholesomely than other firms are doing it. So I think bringing together the established industry we have here, bringing together policymakers and the strong talent base we have, we're very confident that we can actually combust large winners and really catch up in this next decade.
OK, Jeannette, really appreciate your time. Jeannette Furstenberg, the Managing Director of General Catalyst, on that $8 billion raise for that venture capital firm. Now, staying on technology with a particular lens on what's happening in the city of Cambridge here in the UK. The English city of Cambridge has been billed by some as the next Silicon Valley due to its fast-growing tech and life sciences industry. Bloomberg's Tiffany Choi joins me for more. Tiffany, you've done a deep dive on this. Thanks for joining us in the studio. Really fascinating in terms of how Cambridge is trying to position itself. But there are challenges, clearly. What are those challenges? What did you find?
Yeah, lots of challenges, absolutely. And that's exactly why a lot of residents in Cambridge have actually kind of been like, hold your horses, like, maybe we shouldn't see San Francisco as a simple goal to emulate. I mean, firstly, the two places are very, very different, but what's not so different is that inequality is rife in both of them. And in Cambridge, it's only really getting worse. I mean, you have a situation where there's massively growing population, but just not the infrastructure and average salary keeping up to meet that population. So housing prices in the last decade actually grew by 78% and average pay by 23%. And Cambridge is actually the second most unaffordable place to live in the UK, just behind London. And on many other objective metrics, it just has some of the worst inequality in the UK. So despite having its world-renowned university, educational attainment inequality is some of the worst. The gap between high earners and low earners is one of the highest in the UK. And you have a situation where, high-income neighborhoods and low-income neighborhoods are right next to each other. And someone living down one street can be expected to live around 10 years fewer than another person living down, just the next street. So, yeah, I think it's a city that's facing these really core problems right now of things like water scarcity, a housing shortage, traffic congestion due to a lack of transport links. And it's clearly rapid growth. It's leaving quite a lot of people
behind.
And
it feels like, at least on some measures, Cambridge is a key litmus test for this government. If they can't get Cambridge to work as a kind of Silicon Valley-esque city with all of that potential, then the UK is just not going to be as well positioned as many would hope. What is the government doing?
Yeah, so there is reason to be optimistic. I think with the Labour government's pledge to kind of get Britain building and revive growth, everything does suggest that this is going to be a priority of theirs. I mean, it's been a little bit slow going because of the recent change in government. But look, what I have to say here is it's not just about making sure the growth is inclusive. It's also that, the exact ambitions they have for this city just won't be fulfilled if we don't have the corresponding infrastructure. So, if we don't have the office space, the lab space, the transport links for people to commute to those spaces, the homes from which they commute, then it's just not going to be a hub of any kind. And yeah, I think, the ministers recently wrote a letter to local leaders, but it's going to be a long road ahead. And I think in our budget constrained times, it's going to take a lot of money, a lot of time. It's yet to be clear where we're going to find that.
Great reporting. Tiffany Choi, thank you very much indeed. You can find it, of course, on Bloomberg.com and on The Terminal, the challenges around Cambridge, what it tells us about the UK's broader tech ambitions. There's plenty more coming up. This is Bloomberg.
The US economy is one of the strongest among the major economies, if you look at those. And when we compare the US to the other G20 economies, it's the only economy whose GDP is higher now than we had projected before the pandemic. The only major economy. So it's a very strong economy, a lot of confidence in it.
IMF First Deputy Managing Director Geeta Gopinath there on the strength of the US economy. And you can't talk about the strength of the US economy without talking about its tech titans. And what a day for Tesla yesterday on the back of those blowout quarterly earnings. The biggest profit increase they've seen in over a year in that quarter. And the reaction to the markets, the market reaction to that, incredible in terms of the superlatives. The market cap of Tesla increased by $153 billion. This was the biggest jump, 22% increase in the session yesterday for Tesla, the biggest increase we've seen in more than 11 years. Market cap addition of $153 billion. Elon Musk's wealth increasing just yesterday by about $34 billion. He projected out sales growth and deliveries growth of around 30% into next year, and that was certainly part of the positive narrative for investors in Tesla. We'll see how, of course, it performs later today. Let's flip the board and have a look at the macro picture when it comes to where investors are putting their money and to what extent the dry powder of cash sitting in money markets could be turned and put into use around the equity market story of the US. This is a reminder, despite the fact that we're near record highs, of course, in terms of US stocks, you have $6.5 trillion right now, a record amount sitting in money market funds in the US. Investors still trying to get exposure to that high yield, even as the Fed cuts interest rates. Of course, money markets are slower to pass on those rate cuts. And of course, you're still getting a much more higher yield than you would in a bank deposit or in bank deposits. And you see just this year alone, half a trillion dollars moving into these money market funds. So arguably that could be another catalyst and another leg higher for equity markets if and when investors start to move out of money markets and put that play in the stock markets. Now, at 3:45 p.m. London time later today, we're going to be speaking with the CEO of Deutsche Bank. That's going to be pretty fascinating on the back of their earnings, of course. And on Monday, we're going to be speaking with the OpenAI CFO, Sarah Fryer. Do not miss that conversation, starting at 3 p.m. UK time. The opening trade is up next. This is Bloomberg.